Welcome to the Banker Lamp. Please enjoy the video.
You begin by assembling your balance sheet inputs now. Gather bank statements, recent valuations, loan schedules, and invoices. Classify each item as an asset or liability immediately. This prevents double counting. Once done, assign current values, use market or book value consistently, and note any restricted or pledged assets. Make sure to pick a single reporting date and currency because consistency matters for comparison. You'll use these classified, dated figures in the next step to calculate totals and adjust for accruals. Now you add and reconcile. Compute subtotals for current and non-current assets, then total them. Do the same for current versus long-term liabilities and produce a liabilities total. Reconcile each line by matching ledgers to statements. Resolve timing differences with accrual adjustments. Adjust asset balances for depreciation, impairment, or market revaluation where appropriate. Once balances match supporting documentation, you have reliable totals for both sides. These are what you'll combine to derive net worth in the final step. You finish by calculating net worth. Subtract total liabilities from total assets and record the result as equity. Explain why this matters. It shows residual interest after claims are removed and ties to owner's equity. Once done, verify that closing equity reconciles with retained earnings and recent profits or distributions. Perform a continuity check. If you find a mismatch beyond a small tolerance, trace differences to journal entries, valuation assumptions, or unrecorded liabilities. Correct the root cause and rerun the totals.
Thanks for watching. If this was helpful, leave a like and consider subscribing. See you next time.